Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for the 18th of August here in 2022. It is a mid-month update, and we'll talk about some of the key stocks, two stocks that have earnings, and the big picture in the S&P equity futures. Take a look at the bond market, yields, oil, gold, and anything else we have to talk about in this video. So let's get started. We still are in this context of this much and no more, almost like Gandalf in Lord of the Rings. You shall not pass. But that's not a guarantee. That is the probability. And what the you shall not pass level is, for the moment, it's that 200-day simple moving average in the S&P 500. We did see the market pass a zone from 4,200, and that sent the shares or the market squeezing up in the risk zone, still the risk zone, to that upper resistance point. That's true in the S&P. And that level against the 43.22 or 43.25, roughly speaking, level, and 42.11, and just under that at 4,200. To the Nasdaq, which is our technology-centric index, that didn't quite make it. That was just about under that 14,000 level. It had its peak so far, again, at the end of the week, middle of August, so far, just shy of the 13,800 in the Nasdaq. And again, the same concept, the same frame that I've been putting on evening videos, and maybe even referencing as well, which is this is the risk zone, and this is the reward zone, or the reward pathway. Now, what does that mean exactly? It means with positions, when the market is up 5, 6, 7, 8, 9, 10 days, or 10% or 15% or something like that, the odds of additional upside action are low. Possible? Yes, but very low likelihood just observing price action over the years. We normally have pullbacks and retracements and what we call wiggles and squiggles. What does that mean? A down move, an up move, a down move, an up move. That's a very big down move followed by, or up move, followed by a very big down move. And even it had its own wiggles and squiggles. So it's not necessarily a good idea from a risk control standpoint to see a very large upswing, call it a sustained upswing, and start getting long. Because to you, if you're going long after a strong rally, that is a risk of the market falling. It's a risk going against the position. A risk just means you will be losing money if the market does turn and go to lows. And your reward, ideally, would be an upside move, but that's, again, against historical norms. But against the norm does not mean predictive. So that's why we call this the risk zone, because the probability does favor a pullback, retracement, or sell swing. It doesn't necessarily have to be all the way to the lows, not necessarily, but just looking at other times that the market has rallied, even in the context of the bear market or downtrend, it has fallen. So that's the thought process going into the middle of August and as we go into September, with the reward still favoring the downside and the risk to the upside. But if you're getting bullish right here, the script is flipped. This is your risk and this is your reward to the upside. Markets don't, even in large ending of a bull market, it's not a great idea to start going long after such a rally. That's the main idea to communicate. In the Dow mini futures, not much different, and its upper resistance is just shy of that 3,4,500. In our small cap, the Russell, that is up into its resistance point at 2020, right? Hindsight 2020, but the price index here also 2020. And we have seen a short sell or a bearish move take place the last few sessions here in the middle of August. Now that's the S&P, that's the equity futures, and that's the general thought, whether you're playing in the option market or into the SPX or into futures or other positions. Again, the reward pathway, probability pathway, again, that is asking a lot of the market, but still probabilities, even after large upswings, do favor a low yet to come, or at least a pullback. Stepping over into the bond market now. Similarly, we've had a downtrend in the equity market and a downtrend in the bond market, looking at TLT. But we can easily, or just as easily, see that in ZN, which is strictly the 10-year Treasury note, and ZB. ZB is the 30-year Treasury bond. Similar conversation. Markets don't go straight down. It's not a good idea to becoming short or bearish after a sustained down move, because the risk is for a pullback. And the other things are true after the market has gone down. We don't want to get short at the lows. By the same thought, we don't want to get long at the highs. Longs are done off lows or off of lower points, not after a rally, especially one that has taken the bond market roughly 10% from the low. Now, the same can be said on the other side of the bond market. And this is where we are all focused. It's the yield. The Fed raising rates more aggressively, inflation higher than expected, lower than expected, the jobs, the unemployment rate better than expected, more jobs created, the economy stronger than it seems. So that gives the Fed room to raise. And if inflation continues rising, that is a precursor for additional higher rates by the Fed, and that's what we all are watching. And the Fed minutes came out just recently, just yesterday. But for the moment, we're looking at this 3% yield. So that is the focal point for all of us. And of course, the 2-year yield as well, and how that plays into the broader yield curve inversion. But we're just talking right now about the 10-year Treasury note yield. And that 3.0 represents 3%. 3%. 2.0 represents 2%. And that is where the market is hovering at this point. It has created an uptrend alongside, of course, bonds pricing and the yield go opposite. And that is what we are watching very closely going into the next month. 3%. Outside of the bond market, we continue watching crude oil. And crude is one of a barometer or basket of things that we watch with inflation. So earlier in the year, the conversation was about how high inflation is and how much we're getting in the inflationary push. Crude was part of that. Other commodities, such as wheat, were part of that too. Inflation is rising prices in commodities in general, and that's a simple way to look at it. But we have seen the opposite. That's the big picture, that commodity prices, including wheat, including others, and including crude oil, has traded lower. That is like a steam valve releasing. And inflation across the board, gas prices at the local gas station, they have been declining week over week. That is a good sign for the economy. And that is a bullish sign as gas prices have traded lower. We will be watching for the moment here this 86, 87, 88 level for crude oil. Taking us back to a weekly chart, we see that that is a long-term trend line that the market is interacting with or trading into right now. We'll call that a pivot point. Think of it as just the opposite pivot point of the stock market. What I mean by that is the stock market has rallied up into its 200-day moving average and could turn down. Crude oil, from a chart perspective, has fallen into its 200-day moving average and could rally higher. The bond market notwithstanding, which could fall to lows. And outside of all of that is the US dollar index. And that US dollar index, another thing we're watching very closely here in TheoTrade, is the series of higher highs and higher lows. That creates an uptrend in the dollar. And that's been the case for the bulk, almost all actually, of 2022. The going trade at the moment is a bullish opportunity, bull flag, if you will, which takes the dollar potentially up to prior highs. That is the going pathway, and that is the direction of the dollar for the moment. What might that say about the equity market? That might be bearish for the equity market to see that turn down. All these things are in play, whether you trade all these markets, some of these markets, or none of these markets. Meaning you trade ETFs, financials included, technology, or the others. One quick note about utilities, and that they are at 52-week highs. Speaking of 52-week highs, take a quick look at our scan. We did this in last Monday's video. These are stocks right now, here on the 18th of August, making new 52-week highs. Southern Company, Northrop Grumman, Progressive, Waste Management, American Electric Power. So a lot of them are utilities based, but they're in the S&P stocks making new highs. And a quick summary of the largest market cap: Southern Company, again uptrend; Northrop Grumman, uptrend; Progressive. All of those are joining up there with the utility sector making highs. So some stocks are actually at those highs. Now, before we conclude the video, there are two major stocks that are going to be releasing earnings in tomorrow's session. They are John Deere, which is itself into a 370 per share level. Implied volatility 112%, makes an current expected move of about $18. And the other stock that we will be watching is Foot Locker. Foot Locker is also into a resistance point, again this much and no more, very similar to the S&P. That is in a 33.50 per share, and its earnings-based expected move has a higher volatility, 256%, but that's a $3.50 move. All these things and more we'll update, we'll watch, we'll play, we'll trade, we'll hedge throughout the remaining days in August. As always, be careful and safe. This is Corey Rosenblum with tonight's Theo video update for August the 18th, 2022.